Pfizer. Man, that name was on everyone's lips during the pandemic, right? A true titan of global health. But for investors, the story since then has gotten, well, a lot more complicated. So today we're diving deep into the big question. Is Pfizer stock a seriously overlooked value play, or is it just a post-pandemic trap?
Okay, so let's get right into it. For a company that played such a massive role on the world stage, you'd think its stock would be an absolute superstar. But it's not. So what gives? Why is there this huge disconnect between Pfizer's recent global importance and how the market is valuing it today? That's exactly what we're here to find out. To really get a handle on what Pfizer's worth, we first have to understand what the company actually is today. Now that all that extraordinary pandemic money is fading in the rearview mirror. At its core, Pfizer's whole business model is about monetizing science. It's a pretty clear cycle. It starts with research and development. They get a big boost from buying other companies, and that all results in new medicines sold around the world. It's this constant high-stakes loop of innovation, patent protection, and sales.
And this right here, this is the crucial point. The entire story that investors are looking at has totally shifted. The era of Pfizer being a pandemic cash machine is over. Now it's being judged like a traditional pharmaceutical company again, with all the usual pros and cons that come with it.
All right, so let's follow the money. In this next part, we're going to put on our investigator hats, dig into the numbers, and really try to figure out what this company is truly worth, separate from all the daily market noise.
Which, of course, brings us to the million-dollar question, or in this case, the $32 question. If we strip away all the hype and the short-term panic, what's the real, fundamental value of a single share of Pfizer? And here's the headline number, $32 per share. That's the estimated intrinsic value based on a deep dive into the company's ability to make money over the long haul. Remember that number, it's going to be our anchor for this whole investigation. Now this is where it gets really interesting. You take that $32 value and compare it to the current stock price, which is hovering around $26, the analysis suggests it's trading at about a 20% discount. For value investors, that gap is what's known as a potential margin of safety.
This table gives us a little peek under the hood at how we got to that number. Notice how there are two different methods here, one looking at future cash flow, the other at its earnings history. The cool part is they both point to a value that's higher than the current price. Blending them together gives us that more solid $32 estimate. But of course, numbers only tell you half the story. Now we have to look at the qualitative side of things, its competitive advantages, or moats, and the potential dangers, the minefields that might be waiting down the road. And this really shows you the two realities of Pfizer today. On the one hand, you have its incredible strengths, massive global scale, a wide range of drugs, and a really strong dividend. We're talking over 6%. But on the other hand, you have the weaknesses. It's not super efficient at turning its investments into profit. It also depends a lot on buying other companies for growth, and it isn't really the #1 player in any single category. So, what are those minefields? Well, first, there's the infamous patent cliff. That's when a blockbuster drug loses its patent and suddenly has to compete with a flood of cheap generics. Ouch. Then there's the monumental task of integrating the huge Seagen acquisition. Add in the constant political risk of drug pricing reforms and the simple scientific risk that key drugs in the pipeline might just fail. It's a pretty clear picture of the challenges they're facing. So we've looked at the business, we've crunched the numbers, and we've sized up the strengths and the risks. I think it's time to put all these pieces together and officially close the case on Pfizer. And the final verdict? It's captured perfectly in this quote. The investment case for Pfizer isn't about some explosive get-rich-quick growth. It's for a very specific kind of investor, someone who's looking for good dividend income plus a little bit of steady growth on top. For that person, the stock is looking pretty attractive. This table makes that idea even more concrete. Think of it like a roadmap. If your target is a 6% annual return, the analysis says the current price, around $26, is a decent entry point. But if you're a bit more ambitious and you're aiming for, say, an 8% return, you'd probably want to wait for the price to drop closer to 22. And hey, just for full transparency, all the data and the valuation we've walked through today are based on a really detailed report that was published on saveinvestcompound.com. Which leaves us with one final big question. Pfizer really presents a clear trade-off. You get that high dividend, which acts as a nice safety net, but in exchange, you're probably looking at slower growth. So the real question you have to ask yourself is this. Does this slow and steady, income-generating giant fit the goals of your portfolio?